Hi students, welcome to Sunil's tutorial. My name is Sunil Nirwani and today we will be doing a chapter called as capital budgeting. Okay, let's see this. We are doing illustration 15 on page 291. They've given you that Speedage Company Limited is considering a project which costs 5 lakhs. The estimated scrap value is 0. Tax is at the rate of 55%. The company uses straight line depreciation and the proposed project has a cash inflow before depreciation as follows. Okay. The first thing that you do is you calculate depreciation. Depreciation is cost minus scrap upon estimated life. The cost of the project is given to you as 5 lakhs. Scrap value is given to you as nil divided by estimated life. Now the life of the project, the life of the asset is not given to you, in which case you will consider the life of the project to be the life of the asset. So this will come out to be 1 lakh. Right? Next, we know they've given you the cash inflow before depreciation and tax. Right? They have given you net profit before debt less depreciation will give you profit before tax, less tax will give you profit after tax, add depreciation will give you cash inflow. Let's see this. They have given you data for 5 years, 1, 2, 3, 4 and 5. Right? The cash inflows are given to you as 1,50,000, 2,50,000, 2,50,000, 2 lakhs and 1,50,000. Right? These are the cash inflows given to you. Depreciation you just calculated is 1 lakh. So this is 1 lakh for all of them. Depreciation is 1 lakh for all of them. Now net profit before depreciation less depreciation. This is going to be 50,000. This is going to be 1,50,000. This is going to be 1,50,000. This is going to be 1 lakh. And this is going to be 50,000. Right? Less tax. Tax is given to you at the rate of 55%. Right? 55% of this 50,000 is 27,500. Of 1,50,000 is going to be 82,500, 82,500, 55,000 and 27,500. So you will get your profit after tax as 22,500. This is going to be 67,500. 67,500. This is going to be 45,000, 35,000, 45,000. This is going to be 45,000 and this is going to be 22,500. Depreciation, add back the depreciation. So this is 1 lakh, 1 lakh, 1 lakh throughout. So this will give you your cash inflow. Cash inflow here is going to be 1,22,500, 1,67,500, 1,67,500, 1,45,000 and 1,22,500. Right? These are your cash inflows for 5 years. Find the total of this cash inflow. How do I get the total? Add all these figures. When you add all these figures, you will get the answer as 7,25,000. Excuse me. So total is 7,25,000. Now, next thing that you have to do is find out fake payback period. Fake payback period is original investment or original cost divided by average cash inflow. Right? My original investment for the project is 5 lakhs. Average cash inflow will be 7,25,000 divided by 5. Sorry, 7,25,000 divided by 5. So when you do this is going to be 5 lakhs divided by 1 5 are 5, 6, 7, 2 are 10, 11, 12, 5. 1,25,000. So this will come to 3.448. So your fake payback period is 3.448, right? Once you have this, at the end of the book, you have something called as table B, which shows you cumulative present value, right? Now, since you have done this for 5 years, in 5 years, try to find two figures, one which is slightly greater than this, one which is slightly less than this. So, when you look at your table B, you will see that you have a figure called as 3.605 in 5 years, and you have a figure 3.433. Now, we know that 3.605 is slightly greater than 3.448, which is slightly greater than 3.433. Now 3.605 corresponds to 12% and 3.433 corresponds to 14%, right? Therefore, I will get D1 is 12% and D2 is 14%. So the discount factors are 12% and 14%, right? Once you have this, now you have to find out the present value for these. Right? Now the cash inflows are 1,22,500. You have just calculated this, guys. You have just calculated this. 1,22,500, 1,67,500, 1,67,500, 1,45,000, and 1,22,500. Right? Now your D1 was 12%. So find out present value factor at the rate of 12%. How will you find that out? You will find that out from your table A. In table A, look at 12%, you will get this as 0.893, 0.797, 0.712, 0.636 and 0.567. These are your present value factors at the rate of 12%. So now you can find out your present value at the rate of 12%. How do you do that? Cash inflow multiplied by present value factor. So 1,22,500 multiplied by 0.893 will give you 1,09,392. You will get 0.5, let the decimal be. So this will be 109, 1,09,392. Right? Similarly, 1,67,500 into 0.797 will give you 1,33,497. 1,67,500 into 0.712 will give you 19,260. 1,45,000 into 0.636 is 92,220. And finally 1,22,500 into 0.567 is 69,457. Right? Now when you add all of this, you will get 5,23,826. Right? So this is going to be your total PV. So you found out for discount factor D1. This is total PV of D1. Now similarly, find out the present value factor for D2, which is 14%. Present value factor at the rate of 14%. Again, you will see table A behind, and from table A you will get the 14%. Fine, you will get your present value factor at the rate of 14%, which is nothing but 0.877, 0.769, 0.675, 0.592, 0.519. These are your present value factors at the rate of 14%. Next, find out the present value at the rate of 14%. How do you do this? Cash inflow multiplied by the present value factor. So 1,22,500 multiplied by 0.877, which will give you 107,432. 107,432. You will get a decimal answer. I'm now taking the decimals, guys. Next, 167,500 into 0.769 will give you 1,28,807. 1,28,807. 1,67,500 into 0.675 is 1,13,062. 113,062. 1,45,000 into 0.592 is 85,840. 85,840. And 1,22,500 into 0.519 is 63,577. Add this. If you add this, you will get 4,98,718. 4,98,718. This is going to be your PV, total PV of D2. Right? Once you've done this, then you find out internal rate of return. How do you find out internal rate of return? Internal rate of return is given by the formula D1 plus PV of D1 minus original investment or cost of the asset divided by PV of D1 minus PV of D2 into D2 minus D1. Right? So your D1 is 12 plus PV of D1 5,23,826 minus original cost 5 lakhs. PV of D1 5,23,826 minus PV of D2 498,718. D2 minus D1, that is going to be 14 minus 12. Right? So when you solve this, you will get this answer as 13.89%. Approximately you will get this answer. So your internal rate of return is 13.89%. Next. Now in the sum they have given you that your cost of capital is 12%. Cost of capital, guys, towards the end of the sum they have given you is 12%. Internal rate of return you just found out as 13.89%. As internal rate of return is greater than cost of capital, therefore project is selected. That's how you decide whether you should select a project or you should reject the project. This finishes this sum. We will stop here for the day. Thank you very much.